Introduction. A. The idea of inflation. Inflation is a fundamental economic concept that refers to the general increase in prices of goods and services over time, which consequently reduces the purchasing power of money. It is typically measured by the Consumer Price Index, CPI, or the Producer Price Index, PPI. Various factors contribute to inflation, including increased demand for products, rising production costs, and expansionary monetary policies. Understanding inflation is crucial as it affects every aspect of the economy, from the cost of living to the stability of financial markets. B. Cryptocurrency rise in response to inflation. In past years, the rise of cryptocurrency has emerged as a significant development in response to inflation. Cryptocurrencies, such as Bitcoin and Ethereum, offer an alternative to traditional fiat currencies that are susceptible to inflationary pressures. Unlike fiat currencies, which are issued and regulated by governments, cryptocurrencies operate on decentralized networks using blockchain technology. This decentralization provides a hedge against inflation, as cryptocurrencies have a fixed supply or a predetermined issuance rate, making them less prone to devaluation. Cryptocurrencies' appeal as a store of value and medium of exchange has grown, particularly in regions experiencing economic instability. Investors and the general public are increasingly looking to digital assets as a means to preserve their wealth and protect against the eroding effects of inflation on their savings. Through this information, you will learn how to harness the power of cryptocurrency to protect your financial future in an inflationary environment. Whether you are an investor, a financial professional, or simply someone interested in the evolving world of digital currencies, this book will serve as a valuable resource for understanding and navigating the complexities of inflation and cryptocurrency. 2. Understanding inflation. A. Definition and causes of inflation. Inflation is defined as the rate at which the general level of prices for goods and services rises, leading to a decrease in the purchasing power of a currency. It is a critical indicator of economic health and can be influenced by various factors, including 1. Demand pull inflation occurs when demand for goods and services exceeds supply. This can happen during periods of economic growth when consumer spending increases rapidly. 2. Cost push inflation, triggered by rising costs of production, such as wages and raw materials, which businesses pass on to consumers in the form of higher prices. 3. Built-in inflation, also known as wage price inflation, it happens when workers demand higher wages to keep up with rising living costs, and businesses increase prices to cover higher wage costs, creating a feedback loop. 4. Monetary policy, national banks may influence inflation through their control of the money supply and interest rates. Expansionary policies, such as lowering interest rates and increasing the money supply, can lead to higher inflation. 5. Imported inflation, when the prices of goods from outside the country rise, domestic prices can increase as well, contributing to overall inflation. B. Past examples of inflationary periods. In history, there have been some periods of high inflation. 1. Weimar Republic, 1921 to 1923. Post-World War I Germany experienced hyperinflation due to reparations payments, increased printing of money, and economic instability. The German mark lost nearly all its value, causing prices to skyrocket. 2. 1970s oil crisis. The 1970s saw significant inflation all over the world, triggered by oil price shocks when OPEC countries imposed an oil embargo. This led to stagflation, a combination of high inflation and stagnant economic growth. 3. Zimbabwe. 2000s Zimbabwe experienced one of the highest hyperinflations in history of the world, with inflation rates reaching 89.7 sextillion% in 2008. Which was due to economic mismanagement, land reforms, and too much money printing by the government. See impact of inflation on economies and individuals. Inflation has wide-ranging effects on both economies and individuals. 1. Economies. Reduced buying strength. High inflation removes the value of money, making products and services more costly. Uncertainty and low investment. businesses may be reluctant to invest due to unpredictable costs, leading to sluggish economic growth. Interest rates. Central banks may increase interest rates to combat inflation, which can slow down borrowing and spending. Currency devaluation. High inflation can weaken a country's currency, making imports more costly and leading to a trade deficit. 2. Individuals. Cost of living. As prices increase, the price of essential goods and services, such as food, housing, and healthcare, increases, reducing disposable income. Savings and investments. Inflation can hinder the real value of savings and fixed income investments, diminishing their buying power over time. Wage price spiral. Workers may ask higher salaries to keep up with rising prices, which can lead to further inflation if businesses increase prices to cover salary costs. De-inflation measurement metrics. Inflation is measured using various indices and metrics that track changes in price levels over time. 1. Consumer Price Index, CPI, measures the average change in prices paid by consumers for a basket of goods and services. It is the most commonly used indicator of inflation. 2. Producer Price Index, PPI, tracks the average change in selling prices received by domestic producers for their output. It provides insights into inflation at the wholesale level. 3. Gross Domestic Product, GDP, deflator, measures the change in prices of all goods and services included in GDP. It reflects inflation in the broader economy. 4. Core inflation, excludes volatile items such as food and energy prices to provide a clearer picture of long-term inflation trends. Understanding these metrics is crucial for analyzing inflation's impact on the economy and making informed financial decisions. 3. Traditional responses to inflation. A. National bank policies. Central banks play a crucial role in managing inflation through monetary policy. They employ several tools and strategies to control inflation and stabilize the economy. 1. Interest rate adjustments. Central banks can raise interest rates to reduce borrowing and spending, thereby cooling down an overheated economy. Conversely, they can lower interest rates to encourage borrowing and spending when inflation is low. 2. Open market operations. This involves the buying and selling of government securities in the open market to regulate the supply of money. Selling securities withdraws money from circulation, reducing inflationary pressures, while buying securities injects money into the economy, potentially increasing inflation. 3. Reserve requirements. Central banks can cancel the reserve requirements for commercial banks. Increasing the reserve ratio means banks have less money to lend, which can help reduce inflation. Decreasing the ratio can increase the money supply and stimulate economic activity. 4. Quantitative easing, QE. In times of very low inflation or deflation, central banks may use QE, a strategy of purchasing long-term securities to increase the money supply and lower interest rates, thus encouraging lending and investment. B. Government intervention and fiscal policies. Governments also implement various fiscal policies to combat inflation and stabilize the economy. 1. Taxation policies. Adjusting tax rates can influence consumer spending and business investment. Higher taxes can reduce disposable income and spending, helping to control inflation, while lower taxes can stimulate the economy. 2. Government spending. Reducing public expenditure can help cool down an overheated economy by decreasing overall demand. Conversely, increasing government spending can boost economic activity during periods of low inflation or recession. 3. Subsidies and price controls. Governments may provide subsidies to lower the cost of essential goods and services or impose price controls to prevent prices from rising too quickly. However, these measures can lead to market distortions and shortages if not carefully managed. 4. Public debt management. By managing public debt effectively, governments can influence inflation. Reducing deficits and managing debt levels can help maintain economic stability and investor confidence. See hedge mechanisms, gold, real estate, and bonds. Investors and individuals use various hedge mechanisms to secure their wealth from the erosive effects of inflation. 1. Gold. Historically, gold has been a reliable store of value and a hedge against inflation. Its value tends to rise when inflation is high, making it a popular choice for investors seeking to preserve their wealth. 2. Real estate. Real estate investments can provide a hedge against inflation as property values and rental income often increase with rising prices. Additionally, real estate can offer a stable income stream and potential for capital appreciation. 3. Bonds. Treasury inflation-protected securities, TIPS. These are government bonds specifically designed to protect against inflation. The principal value of TIPS increases with inflation, as measured by the CPI, providing a secure return that keeps pace with rising prices. Real return bonds. Similar to TIPS, these bonds offer returns that adjust with inflation, ensuring that the investor's purchasing power is maintained. 4. Commodities. Investments in commodities, such as oil, agricultural products, and metals, can also serve as a hedge against inflation. Commodity prices tend to rise with inflation, providing a potential safeguard for investors. By understanding and utilizing these traditional responses to inflation, central banks, governments, and individuals can effectively manage and mitigate the impact of rising prices on the economy and personal finances. 4. Emergence of cryptocurrency. A. What is cryptocurrency? Cryptocurrency is a type of digital or virtual currency that uses cryptography for security, making it difficult to counterfeit or double spend. Unlike traditional fiat currencies issued by governments, cryptocurrencies are typically decentralized and operate on blockchain technology. A blockchain is a distributed ledger enforced by a network of computers, nodes, that maintain a continuously growing list of records, blocks, each securely linked to the previous one. Key features of cryptocurrencies include decentralization. Most cryptocurrencies operate on decentralized networks, meaning no single entity or government controls them. Anonymity and transparency. Transactions can be conducted anonymously, but they are recorded on a public ledger, ensuring transparency. Security. Cryptographic techniques ensure secure transactions and control the creation of new units. Limited supply. Many cryptocurrencies, like Bitcoin, have a fixed supply limit, which can make them less susceptible to inflation. B. History and evolution of cryptocurrency. The concept of cryptocurrency has evolved significantly since its inception. One early concepts, the idea of digital currency, has been around since the late 20th century, with early attempts like DigiCash and BitGold, which laid the groundwork for future developments. 2. Bitcoin, 2009. Created by an unknown person or group of people using the pseudonym Satoshi Nakamoto, Bitcoin was the first successful decentralized cryptocurrency. It introduced blockchain technology and solved the double spending problem without the need for a trusted third party. 3. Expansion and altcoins. Following Bitcoin's success, numerous alternative cryptocurrencies, altcoins, were developed, each with unique features and use cases. Notable examples include Ethereum, introducing smart contracts, Litecoin, faster transaction times, and Ripple, focused on banking sector integration. 4. Mainstream adoption. Over the past decade, cryptocurrencies have gained wider acceptance, with increasing use in financial transactions, investments, and as a store of value. Major companies and financial institutions are exploring blockchain technology and integrating cryptocurrencies into their operations. See characteristics of cryptocurrency as an inflation hedge. Cryptocurrencies possess several characteristics that make them attractive as a hedge against inflation. 1. Limited supply. Many cryptocurrencies have a capped supply. For instance, Bitcoin has a maximum supply of 21 million coins. This scarcity can protect against inflation, as the value is not easily diluted by an increase in supply. 2. Decentralization. Being decentralized, cryptocurrencies are not subject to government policies or central bank decisions that can lead to inflation. This independence can provide a safeguard against the inflationary pressures that affect fiat currencies. 3. Worldwide accessibility. Cryptocurrencies can be accessed and used globally, offering protection against localized inflation. This is particularly beneficial for individuals in countries experiencing hyperinflation or economic instability. For store of value, similar to gold, cryptocurrencies are increasingly viewed as a store of value. Investors turn to them to protect their wealth during times of economic uncertainty and rising inflation. 5. Transparency and security. Blockchain technology ensures transparency and security in transactions. The immutable nature of blockchain records reduces the risk of fraud and enhances trust, making cryptocurrencies a reliable alternative to traditional currencies. The emergence of cryptocurrency represents a significant shift in the financial landscape. By understanding its fundamentals, history, and potential as an inflation hedge, individuals and investors can better navigate the evolving economic environment and explore the opportunities presented by digital currencies.